The idea was it would be easier for the government to spend its own money and buy the resources that the government would need to provision itself. The question is, how do you get the currency accepted? So how do you create sellers of labor, sellers of goods and services? And the answer to that was that you impose tax liabilities. In the very beginning of paper currency systems, you had governments creating tax liabilities per capita, poll tax or a hut tax. This means the idea of tax liabilities is prior to spending money. So there's a very important role for tax liabilities, at least at the start of the monetary system, because you need to make people accept your currency. You create a demand for currency, which means also that you create unemployment in the sense that we are using the concept ever since. Before you have taxation in money, yes, you have poor people, and yes, you have people with no resources, but they're not unemployed, because unemployment is always the situation where you want to work for money.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley, and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia.
And we are delighted, as we always are, when this happens, to be joined once again today by our friend, economist, author, and organizer of the upcoming 2023 European MMT Conference. Yay! It's Dr. Dirk Ehnts. Thanks for joining us today, Dirk.
Yeah, thanks for having me. Always happy to be on your show.
To borrow the title of one of your recent books, let's get straight into some MMT essentials. Long-time listeners to the show will know that every time a currency issuing government spends, it effectively spends new central bank money or reserves into existence, which causes new commercial bank money or bank credit to come into existence. That's our spending money. And I've linked to our episode about how that works in the show notes for this episode. But crucially, a currency issuing government doesn't spend previously collected tax revenue, or to quote former Fed Chair Beardsley Ruml, speaking in 1946, taxes for revenue are obsolete. But there is still a primary role that taxes play in the money creation process, and taxation performs other vital functions in our modern money systems. So, Dirk, how would you describe the role of taxation in modern monetary theory?
Yeah, that's a very good question. Let me start with natural taxes, because before we had money taxes, there were, of course, taxes being paid in kind. So in many societies, people were supposed to surrender 10% of their production directly to, let's say, the church, for example. And when that happened, of course, tax was very easy to understand. It was the part of production that you gave to the state or the church or whatever kind of institution ruled your land. In return, you got normally security or something, but not much more. So money was then introduced to provision the government. So the idea was that it would be easier for the government to spend its own money, and with that money buy the resources that the government would need to provision itself. The question is, how do you get the currency accepted? So how do you create sellers of labor, sellers of goods and services? And the answer to that was the idea that you impose tax liabilities. So in the very beginning of paper currency systems, you had governments, well, more or less creating tax liabilities per capita, or doing something like a poll tax or a hut tax. In Germany, at some point, they taxed windows. So the more windows you had, the more tax you paid, which led to people closing down the windows in order to pay less taxes. So they prefer to live in dark caves rather than pay their fair share of taxes. This means the idea of tax liabilities is prior to spending money. So in MMT, there's a very important role for tax liabilities, at least at the start of the monetary system, because you need somehow to make people accept your currency. And that's the reason why they take it in the beginning, because they know that they will have to pay taxes eventually. Or if they don't have to pay taxes, then other people will have to pay taxes. So there's always going to be a demand for money. So, of course, in modern times, we also have private debt. So people who borrow money from a bank to buy a flat, and then for 30 years they pay, I don't know, £1,000 per month, for example, back to the bank. That, of course, forces them to work for money. And, well, of course, if you go a little bit further, then, of course, taxation is also, of course, important, because you take purchasing power away from the people. So if people produce something and they don't have the money to buy all their production because they have to pay some taxes, that of course makes fiscal space, some would say, or it creates fiscal space for the government to purchase some production that nobody else can buy because the private sector, the households and the companies, they don't have enough money. So also important is the redistributional aspect with taxation. So of course you can take money from the rich and you can give it to the poor. And you can also incentivize people to not to consume alcohol, for example, by putting on an alcohol tax. In Germany, we also have a coffee tax. I think it's still in operation, for example. So yeah, there's a lot of reasons for taxation in MMT.
Can I just jump in? And because it's very easy to say, you said we can take money from the rich and give it to the poor. And that is not exactly how it works. We can always spend, because the government only spends one way, by, as we said before, marking up bank accounts, that the government can't run out of its own money, so to speak. And so we can always spend on the poor and take money away from the rich. It's not the case that we're taking the money away from the rich to give to the poor, right?
Well, it depends on what kind of level you're doing this. So if you are doing it on the federal level, then you are correct. So you can always spend. And then, of course, you would have probably at some point a problem because there's not enough resources. So you need to tax maybe to free up resources for the poor to consume, if that problem arises at all. But at lower levels of government, at the local level or at the state level, if you have taxes there, then of course first you have to tax and then you would have to spend. Because at that level, then the government is also a currency user.
So I read something recently that said that basically at federal level speaking, all government spending eventually ends up in the pockets of large businesses and the rich, in a manner of speaking. So if the government didn't tax the rich, it would just continue on accumulating and to come to dangerous levels of political instability and things like that. So is the action of the government as well, the politically stabilizing action of removing power from the top? Is that an alternative way of seeing it?
Yeah, I would definitely think so. So, I mean, if you have hedge fund managers in the United States, and I think there's an article out there by CNBC. So in 2020, the 25 most successful hedge fund managers, they had an average income in the year 2020 of more than $1 billion. So that's roughly what it costs to finance a campaign to run for US president. And they make that kind of money in 1 year. Of course, that gives a lot of political power to those individuals. And society should ask itself, so is it possible to have a democracy where we're supposed to have one person, one vote, and then we allow these kind of levels of income inequality? I think that this is not going to work out. So yes, if you are the government, you need to ensure that you have a fair distribution of income. And that's, I mean, John Maynard Keynes once put it like this, more or less. He said, well, the big question is, how do you get a society where people have to work together and you have to have a fair distribution of income, but you also have to have full employment. And of course, you have to have a liberal society. So you have to have some freedom. So the big question is, how do you get this kind of society? And that's what he devoted his life for. So he was always doing research and thinking about the institutions that would bring about this kind of society where you have a fair distribution of income, where you have full employment, and where you still have individual freedom. And that's also what we are thinking about today. But of course, with the added issue of having a sustainable economy, which is of course very urgent by now. So that doesn't exist in Keynes's time as a problem, at least not in the public.
I'm just going to jump in here and say that the statistic that you cited, Dirk, about that, a hedge fund manager can earn $1 billion. This, to me, is why I tend to not lean ever so hard into the idea that taxes are going to disempower the ultra rich. Because I think people are, it's just maybe next year we'll raise that tax that will stop there being billionaires that can buy elections. But we've had taxes since the dawn of money, because that's the point of taxes, right? So we've had taxes since the dawn of money, and so far so bad. I get that it does ameliorate some wealth and income inequality, and it's very important, but I don't think that they're getting to that very top echelon of people that can buy elections. I mean, we really don't have to cast our minds back very far, do we? Everybody that runs for president in the US is at least a millionaire, if not a billionaire, right?
Yeah, that's a problem. And I mean, we had this academic debate also with Piketty, with Thomas Piketty. So he says we have to have taxes in order to fix this. And the MMT view more or less is we have to regulate financial markets so that these kind of positions don't even exist. Because once you have a person with an annual income of more than $1 billion, that person, of course, will have a lot of political power to fight any proposal to cut that income in half, let's say, which would still be too much. So, I mean, if you are Piketty, I mean, how high would that have to be if you have an annual income of $1 billion? I mean, 99% maybe.
And when you say 99% tax, well, if you say anything like an 80% tax, people all of a sudden become temporarily embarrassed billionaires. Like, oh, that could be me. The state's going to come for my £1 billion that I'm about to make. And so I guess that's just the psychology of people in our system right now.
Question is, at what time do we stop talking about tax and start talking about confiscation? Because it seems it's gone really far, hasn't it?
Yeah. And again, just in case anybody... don't want to get misinterpreted here. We're talking about the very, very top wealthiest individuals that can buy elections.
Yeah, if you're not rich enough to sole-handedly fund a presidential or political party.
And still remain rich after that.
Yeah, and still remain rich, you have nothing to worry about.
Just to give you an example, so if you make $1,000 million, which is $1 billion, and then I tax 99%, you would still have $10 million as an annual income. Okay, so it's still not so bad.
So I remember at the 2021 Poznan MMT Summer School, which I highly recommend and we highly recommend, which is running again this year from the 5th to the 8th of September. Quick plug there. But in this Poznan MMT Summer School, I remember your class, you drew on the history of the early American colonies to illustrate how fiat currency works. Would you mind talking about that?
Yeah, so this academic paper on the history of paper currency in Virginia in the 1760s. So Virginia was an American colony owned by the British. And it is a nice example of how a paper currency works because there was no central bank, there was no treasury, there was just a government with money printing, so cash. So it's very educational to look at that. And I always do some kind of role play. So the idea is that I take my students back with a time machine into the 1760s. We emigrate from Europe to America. And then we settle on a little island next to, or it's part of Virginia, but it's a little island so that I don't have to talk about anything else but our monetary stuff. And then, of course, when we arrive on that island, we build little huts and we go fishing and maybe we brought some animals, we do some farming and everybody's doing something. So maybe people are poor. Maybe some people are rich because they have more resources, but everybody can get a little bit of land. And then at some point, the people on that island decide, hey, let's build a road, public road, free of charge, and also a public school and hire 2 teachers. And for that, you need money. And when you introduce taxes in Virginia pounds, which is what they did in Virginia back then of course you create a demand for currency, which means also that you create unemployment in the sense that we are using the concept ever since. So it's very eye-opening for the students that they understand that before you have taxation in money, that yes, you have poor people and yes, you have people with no resources, but they're not poor because they don't work for money. Nobody's working for money.
So they're not by definition unemployed at that point in a pre-money society.
Yeah, so that maybe they have no resources and they have nothing to do and they sit around and they don't work, but they're not unemployed because unemployment is always the situation where you want to work for money. That's very clear then that the government, because the government has put those tax liabilities into those balance sheets of those citizens of Virginia. So the citizens of Virginia, they have to pay those taxes. That means they ask themselves, so how do we get that money? So they offer work for money, they offer goods and services for money. They would want to deal with the government or other people who have money. And that's how the paper currency of Virginia, that's how it actually worked. So the paper by Farley Grubb is pretty good. Maybe you can put it into the notes of this presentation.
You just reminded me of the way John T. Harvey likes to say it. I think he says unemployment is always and everywhere a monetary phenomenon, in a sort of sly dig at Milton Friedman.
So sometimes, because our tax system in the UK is so complex and we've got taxes for very many different things, and the way that tax is structured at the moment is that you have a minimum threshold that you can work to. And as long as you don't go over that threshold, you don't pay income taxes. And then if you go over that threshold, then you start paying more and more. Some people might say that the reason why people pay taxes is because they work and they don't work to pay taxes. So contradicting the whole taxes create unemployment. How would you explain that? What would your answer be?
Well, I think the question is, if you ask the question, why are you willing to work for UK pounds? Then, of course, most people will give you an answer which is more or less like, well, I just do. I really haven't thought about it. Or they say, well, everybody else is doing it and I like to buy stuff with pounds, so I do it. So, of course, for an economist, that is not a nice answer. To say that everybody's using pounds because everybody else is using pounds, that's really not the bottom of it. So you have to dig a little bit deeper. And of course, when you establish a currency, then you can see what the answer looks like. And we have ample evidence that historically taxes were imposed to make people accept money. Jaime Minsky also is quoted to have said that it's easy to print money. The problem is getting it accepted. So yes, I would agree that to us, it looks like money is an invention so that we can consume stuff and pay for things. So that's the money user perspective, but nobody's asking the question, so why are governments using their own money? So why does not the United Kingdom now use, euros or US dollars, even though they're not part of the Eurozone? But why not? And the answer is, well, because there would not be a currency issue anymore and they could run out of euros, they could run out of dollars. And then you would clearly see from the currency issuer perspective that it all makes sense.
And another way to talk about taxes, as you recently wrote on Twitter, is that taxes are the price of freedom. Can you lay out what you mean by that?
Yeah, I was very mean just twittering that and not explaining it. Look, the price of freedom is normally that we have guaranteed rights, enshrined in the Constitution. So nobody can hurt us, we can have property, and nobody can, take away our freedom, like enslave us, things like this. And the question is, of course, who's enforcing that? So you can write it down on paper, it's a nice constitution, but you need enforcers, you need police, you need lawyers, you need judges, you need property management, and also you need to have all kinds of things. So you need the state. So the state has always been doing that, protecting, for example, property rights, also creating the currency. So all of that doesn't work if the state has no resources. So if you would say the state has to police people, but we don't give any money to the state, and also we do not allow the state to have its own money, how is the state going to get policemen, for example? Good ones, hopefully. So taxes have to be there. So without taxes, we don't have a government which can get resources to do its job. And that's why I said, well, the taxes are the price of freedom, because without these institutions, we wouldn't have any freedom. So you can go to failed states, for example. For a time, it was like that in, Haiti, Somalia, Afghanistan. There were some regions during some years where no taxes were paid. But of course, your freedom was very low. So people could come and take away your stuff, and that's what you get when you have zero taxes. So that's how I meant it. Probably we'll get back to Twitter next week and maybe write a little blog post to explain.
I think it's okay. I think it's okay to be brief sometimes on Twitter. And I do think you actually went on to unpack the sentence as well. So it was actually fine. But, like you say, you determine what the public purpose is, hopefully democratically. Obviously, you could be under some sort of despotic administration and, well, whatever they say is the public purpose is the public purpose now. But the only way that gets achieved is by the state mobilizing resources. And so far, taxes and the money story as we understand it in MMT are the way that states mobilize resources, I guess, is another way to say it. There's more than one type of freedom, right? There's freedom to and freedom from, right? And whatever the polity decides, the state as an agent of that polity needs to mobilize resources.
And there's more ways of freedom. I was just talking about individual freedom, but of course you can also talk and should also talk about freedom as being part of a social collective, that you have the freedom as a voter to also voice your concerns and make your vote count when it comes to allocation of resources and what society will do. So that, of course, is also very important.
So, like we say, we absolutely do not ignore the purpose of taxes in MMT. It's very crucial to MMT, and it's in fact the beginning of the MMT money story, which we talk a lot about on this podcast. And I bring this up anyway because this week in the UK, the former Chancellor under Margaret Thatcher, Nigel Lawson, passed away. So lots of people are reflecting on his legacy, and one commentator on the BBC this week said that he felt that Nigel Lawson's revolution in policy wasn't so much the Big Bang deregulation that's quite famous that he presided over, but rather it was in taxation, that he lowered taxes dramatically, especially on higher earners, but he offset that with a rise in VAT. So people were taxed more on their consumption rather than their earnings. Now, that might sound progressive when you frame it like that, but why do many economists view VAT actually as a regressive tax?
Yeah, well, the reason is that the rich people and the poor people, they spend their income in different ways. So the rich people are saving quite a lot of money, maybe up to roughly 40%, maybe if we're talking about millionaires, just roughly. So if you save a lot of money, then of course, for that part of your income, VAT is not going to be a problem. But if you are poor, you will probably spend a lot of your income, so almost all of it. And if you're really, really poor, you might even spend more because you go into debt because you have to. Otherwise, you will not make ends meet. So if you spend a high share of your income on consumption goods, then of course, VAT will hit you very hard as a percentage on your income. And that is why if you shift taxes from income taxes towards VAT, that means that the society will be more unequal in the end. That is something which has happened in a lot of countries, also including Germany and including probably also the Scandinavian countries. I think in Greece, VAT was hiked up to something like 24% in the 2010s under the austerity regime. So of course, VAT then hits the relatively poor households. And that's not a good idea if you already have problems with income inequality being too high.
Would it have made a difference if the VAT was only charged on luxury goods? Would that have been more progressive?
Yeah, that would be more progressive. And of course, you could remove VAT from important foodstuffs. You can remove it if you're selling books, for example. So yes, I mean, it's not written into stone that VAT is somehow a regressive tax, but it's in the devil's in the details. But normally we have VAT, which is roughly the same over all products. And then we have some exceptions, but normally it's a regressive tax right now. But also in Germany, there's talk about removing VAT probably from foodstuffs. I don't think that the government will do it, but at least there's some policy debate about that.
So while we're in the Eurozone, you recently noted that the German parliament had published an update on modern money theory, and you wrote that their paper is conditionally suitable as an introduction to MMT. I'm guessing that you're being diplomatic and they may have missed some things. Tell us about the update.
So yeah, I mean, it's not a bad paper, so they get a lot of things right, but it's also very strange because they quote very strange MMT literature. And for example, they point out that I would be the leading MMT economist in Germany. I have 2 books in German and they don't quote any of my books, which is really odd because that's normally where you would go and start. And the German parliament has a library and my book is available in that library for a couple of years now. I checked. So they had the book there. So it's a bit odd what they did there. So yeah, what we can see in the Eurozone is then that we already have a lot of MMT applied in a sense. So MMT insights have been used by the ECB, for example. I think Pavlina Tcherneva has also gone to the ECB for a lecture once. And they know that they have to act as a dealer of last resort, which means that they buy government bonds when nobody else wants to buy them. And they promised to always do that. That was the pandemic emergency purchase program so that all the governments could sell government bonds and ensure that the central bank account always goes back to zero or to positive, which is according to the Eurozone rules. So the Eurozone rules say that you can only spend if you are the government and the central bank account is positive. So that's something which is definitely inspired by MMT because nobody else had said that the ECB should be a dealer of last resort for government bonds. In my book, for example, I have been arguing like this since 2014. And Jörg Bibo, who's also an MMT-leaning economist, He also made that argument in 2013 or 14. I think he said it before I said it. But these are MMT talking points. And also, we always said that the deficit limits are very bad ideas. And there's now a general escape clause in the Stability and Growth Pact. And the 3% deficit limit is part of that Stability and Growth Pact. So the general escape clause was activated in 2020. And that meant that the governments could just spend whatever they wanted to spend. And even if the budget deficit would be very high, like 10 or 11%, like in Spain or Italy, there would be no punishment. So we can see already on the Eurozone, in the Eurozone's institutions, we can see a lot of MMT insights being applied. We also have this debate about reforming the fiscal framework with high-ranking officials from the European Union saying that the current fiscal framework is not, and now I quote, it's not fit for purpose. Okay, so there must be policymakers up high who have understood the problems, the macroeconomic problems that we have with the Stability and Growth Pact, for instance.
But this clause, presumably, was in the treaty way before officials had an understanding of MMT, if indeed MMT has had any sort of influence on their activation of it. But it was always meant to be temporary, was it not?
Whereas the general escape clause had been added in 2011. And I think by 2011, you had already a lot of papers by Randy and by Stephanie about the Eurozone and the way that this is a straitjacket and so on. So I think that the arguments were there. So yes, they activated that in 2020 and they said it's temporary. But the thing is, of course, that now that they've done it, we now have a record low unemployment rate in the Eurozone. So once you take away the rules, which are supposed to protect stability and lead to growth, what you get is you get stability and growth when you remove those rules. And that, of course, has turned a couple of heads. And people have been thinking like, okay, so if the Stability and Growth Pact is deactivated and what we get is stability and growth, well, why turn it back on again? So now there's this big debate, which is, of course, very political, about what to do with the rules. And the Commission has already said that they want to have more individual rules so that you have not one size fits all, but that you have governments which are proposing some kind of adjustment path on the national level. And of course, the Germans who are saying that, no, this cannot work like that.
I mean, their ideas of not equal rules is basically Germany can do everything it wants and then everybody else has rules. Is that not usually the approach they take?
No. The idea is, look, it's very complicated with the Eurozone because it's true, the Germans were breaking the rules in the beginning. So they had budget deficits, public budget deficits in the 2000s when the Euro started. So from 2002 onwards, it was 3%, 4%, 4.5%, 3.5%. So the German finance minister, Hans Eichel of the Social Democrats, he always got a blue letter from Brussels saying that, look, your public deficit is too high. Please change that. And then the other countries were pissed off at Germany and also at the French because they had the same problem. Not really a problem, but that's the statistic. So the other countries like probably Spain and Greece and Italy, they said, well, we want to have stricter rules so that those countries with public deficits that are excessive, that these countries are punished. And then the Germans and the French said, well, okay, let's change the rules. And that was just before the global financial crisis in 2008 and 2009. So those harsh rules that we have that enabled austerity, they've been created by the countries who had been suffering under those rules, which has led to this complicated situation that those countries preferred politically to suffer through the austerity that they impose onto themselves. Well, of course, the Germans did it by applying the rules, which was not necessary. But yeah, it was a complicated political game. And I think by now it's clear that this kind of game will not be repeated. But yeah, it's a power struggle. So the Germans want to go back to the old rules because it gives them a lot of leverage. So if the other countries have public deficits which are too high, then of course the Germans can tell those countries what to do. And that's what they want. Okay, so the rules, the public deficit limits, this is not about economics, it's about politics, it's about power distribution.
While we're in this topic, you recently reshared a paper that you wrote in 2021 with Michael Petz, and that was entitled COVID-19 and its economic consequences for the euro area. And in that paper, you pulled together quite a few MMT insights and you point them at the shortcomings of the Eurozone, some of which we've just heard. And as you write, these shortcomings were already evident after the global financial crisis, and they've prevented economic recovery in the last decade. Is there anything more in that paper that people should know for the current context?
Yes. Thanks for bringing up that paper. So the idea of this paper was to write up an MMT paper without calling it an MMT paper. So the idea was to get other economists interested in the question of what does the pandemic mean for governance in the Eurozone going forward. And Michael Patz, who's at University of Hamburg, and he's an excellent economist also. So we said, okay, let's write a paper in which we just present the facts, and then we move on to policy insights. And instead of criticizing the existing rules, okay, we do that as well. Of course, we say the deficit limits don't work, but we propose to have different policies. So we say it's better to move from deficit targets to full employment targets. So countries have full employment targets, and if the unemployment rate is not at the target rate, then they have to go to Brussels and explain why and how they're going to fix it. Okay, so this of course shifts the paradigm. So instead of looking at fiscal numbers, you look at results in your economy, and you have to explain again why you don't have full employment, which I think would be a very good step forward. Also, we suggest that the ECB becomes also formally a dealer of last resort. It informally already is, but the question is, what is the political price that, for example, Greece will have to pay during the next crisis so that the ECB is supportive? We think that we should have some kind of automatic regime that the ECB is always supporting all countries of the Eurozone, and to take away that potential of the ECB to blackmail other countries into doing what they want, which is what happened in Ireland and also Italy during the last crisis. And the last point that we raise is to remake the New Deal, the Green Deal of the EU, into a Green New Deal where the government is increasing government spending by quite a lot in order to fight climate change and in order to make possible a sustainable economy. So that's the idea of the paper. These are positive goals that we suggest, positive policies. And the paper was very successful. I think it was accessed more than 17,000 times, published 2 years ago. So we are very happy with that paper.
And you shared that paper in response to Olivier Blanchard tweeting about a recent German proposal for the reform of EU fiscal rules, which would require a 0.5% decline in the debt to GDP ratio every year and a 1% annual decline requirement for high debt countries. Can you talk about that proposal?
So they seem to believe that, let me quote here, I have this from EUobserver.com. It says, the paper states that highly indebted countries' GDP growth should always exceed the growth of expenditure, a function described as the convergent margin. So that will be very strange. I mean, they probably mean government expenditure. So yeah, to have countries grow faster than the government spending grows, that would mean that you would have to increase private investment at a fast pace. Of course, you can see that clearly in the United States where you have the Inflation Reduction Act. So if the government spends lots of money, then firms invest so that they can produce stuff that they can sell to the government. So I would say that private investment roughly is a function of government spending. And it's very unlikely to see the private investment going up while government spending is increasing only slightly. But again, this paper, I think it's politics, it's not economics. So what the German government wants to have, they want to have the old rules back, because then the others are always sinners. They always have to come to Brussels to explain why they did not hit the target. They always have to come up with reforms. And then, of course, the Commission can tell them what to do. And that's what they want. They want political power. Okay, so this is why it doesn't work to explain to Wolfgang Schäuble, for example, who was the finance minister of Germany in the 2010s. So if you are the Greek finance minister like Yanis Varoufakis, yeah, you can try to explain economics to him, but he understands the economics. It's just that Varoufakis did not understand the politics of it. Okay, so the Germans want to rule in the European Union, and the way they do this is through the Stability and Growth Pact with the deficit limits. Because they are the net exporting nation, they will not have any problem with that, but the others will. And that means that Brussels can tell them what to do. And Brussels is more or less, Germany is the most powerful nation in the European Union and the largest one as well. So I think it's a political game here. And I think it's, of course, not good for the European Union to have this kind of result where Germany is so dominating. Because if the Germans want to reform the other countries and turn them into net exporters as well, it doesn't work for the population, because what we export, we cannot consume at home, so we will be poorer. And also, you cannot have all countries in the global economy being net exporters. It simply doesn't work that way from the numbers. Somebody has to be a net importer.
Also, while we're on this topic, Dirk, you shared a story from the German press outlining how the, municipalities of Bremen, Saarland and Berlin, among others, are now looking for new ways to finance green investment, and they're bypassing the debt break, which is another fiscal rule. Tell us about how they're doing that.
Well, we have something in Germany which we call Sondervermögen, which is like a special fund. You already notice the framing. So instead of saying it's a special debt, it's a special fund. So now it's an asset instead of a debt for some reason. And this has been allowed for some years at the federal level also. And at the federal level, they have been using that. And they used it again last year very prominently because first they gave 100 billion euros to the German army. So that was a special fund. And then they had another special fund to stop the gas price from rising for consumers. So they said, okay, you pay the old prices and we pay the difference between your bill, the actual bill, and what you used to pay. And that was 200 billion. So these special funds, of course, and also in terms of framing, they were very MMT-like, right? I mean, the government just said, okay, let's spend 300 billion more. I mean, 300 billion is almost the budget of the federal government. And they said, okay, let's spend an extra budget inside of 1 year, roughly. So, of course, you wonder whether the resources are there. That's the MMT question, of course. And now the states of Germany. So Bremen is a town. It's a city, but it's also a state of Germany because it used to be a free town. And also Berlin is a city, but also a state. They also have in their constitutions these possibilities to create extra money, these kind of special funds, which they will have to repay at some point, of course. But if there's a political excuse for spending, let's say, 5 to 10 billion more, they might be willing to do that. So Bremen has said they will do it. And also in Berlin, the new government said they might want to spend 5 to 10 billion extra to make the city greener. And that, of course, is also something which I think is coming straight out of the MMT playbook. And now they're using it. So it was just sitting there as an idea, but now the time has arrived. And yeah, I think these are good signs that we are asking different questions about money. So it's not about the question, how do we pay for it? But the question is, of course, so how many of these special funds will we be able to create without running into problems of supply?
There's a lot of chat about the federal debt break. Is that an EU policy as well, or is it just unique to Germany?
No, the Germans in the wake of the Euro crisis said everybody or all the countries should have in their constitution a debt break. I think not all of them followed suit, but most of them, but they vary a little bit. But I think probably all of them can be turned off, and they were during the pandemic, because otherwise you would have been running out of money, and no Eurozone country did run out of money. So it probably means that they all had these escape clauses. So the German coalition that we have now, which is a Red Party and Green Party, so Social Democrats and Greens plus Liberal Party. The Liberal Party has a finance minister, and he has insisted in the debt break. So the debt break stands, and that means that they will have less money to spend. I think the Liberal Party will be voted out of parliament, because if you don't spend money to solve the problems that your voters have, why should they vote for you again? So I think the Liberal Party is making huge political mistake. They're playing the party pooper. But nobody likes party poopers. They're just telling the other parties, no, you can't spend any more money. But that's very destructive. And I don't think that the voters will honor that. I think probably politically it looks like a good idea for them, because if they feel like they're hitting the other parties hard, and they do that. But that's not what the voters want to see. So probably the people who voted for the Liberal Party wanted to see, for example, taxes come down. But that they did not deliver. And also the other thing that they achieved is basically they tried not to change things. But that's normally not enough. So yeah, let's see what will happen at the next German election. I think the next one it's next year, I think, if I'm not mistaken.
You mentioned earlier as well that there was some discussion about whether the rules on fiscal spending should be more bespoke per country. I wonder, have they made, I mean, for us, the obvious solution would be a job guarantee, which automatically gives more money to the countries that have the highest levels of unemployment. Have they made that connection yet, you think? Or will they ever get there?
Well, the debate has been more about green investment than about unemployment. So countries like Ireland, for example, they wonder how they will be able to green their economy if the money that Brussels is giving the nation states is normally co-funding. So that means that when the Irish government spends $1 billion here, $1 billion there, then they will get from Brussels 500 million here and 250 million there. But if you have to be within this 3% budget deficit limit, then the Irish government cannot increase government spending, and they cannot afford, because of the rules, they cannot afford this kind of investment. And that means, of course, that they will not have a nice economy, which is sustainable. And I was invited to speak at the Finance Committee of the Irish Parliament, I think 2 years ago. And they were wondering how we could change the rules. And one of the ideas was that countries would have individual kind of rules, or the rules would apply to all of them, but you would have individual paths of adjustment to bring down the deficit and the public debt level, which of course means that these are then political things that can be negotiated. So the rules are not so strict anymore that you have to cut spending whenever you break the deficit. So yeah, the job guarantee is also there. We also have this debate now in Germany, whether it would be a good idea to have this. I think in Austria, where they also have elections soon, there's also a debate on a job guarantee for the long-term unemployed. But yeah, the debate in the Eurozone, when it comes to deficits, it's more about public investment and in the context of greening the economy, right?
I'm just relating this back to the role of taxes in MMT and how you said the debate is more focused on investment, green investment, than it is on unemployment. And I'm thinking the way that relates to the MMT view of taxes is, well, to invest, you've got to buy resources, right? And those resources have to be either lying idle at the moment you decide to buy them, or if they're not lying idle, you've got to free them up. This concept of fiscal space. So that's the point of raising taxes on, say, this certain business activity or this certain real resource, and to enable investment. So they are two sides of the same coin.
The problem is just that when you have these deficit limits, you can theoretically, of course, you can just increase your government spending. The fiscal space in the sense that you define it is there. So the Irish would have the workers, they would have the machines and the real estate that they would need to get what they want. But the problem is that probably the public deficit, at least after the first year, it will go up beyond 3%. And that's a political problem. So yes, they can build it, they can run it, the resources are all there, but it's the stupid political rules which do not allow the Irish to get their green economy. And that's what they are trying to get there. So this is the fight that is going on now in Brussels, where the periphery countries and also the other bigger countries like Spain and Italy, where they are fighting to be able to restructure the economy because they have the resources, they would have to change the rules. And the German politicians are trying to extract a high price for changing the rules. So they basically say, well, if you want us to change the rules, what do you give us? And I don't know what will happen. I mean, yeah, it's a political fight, and I don't know what's going on in Brussels behind the scenes. So what is it that the Germans want? No idea. So we'll see what happens.
I think we imagine them to all want the same things, right? But I bet there is some negotiation going on as well that we are not aware of.
I think the German exporting sector is very strong in Germany politically. And if you convert the other countries, I mean, if in Germany you have electric cars and electric buses and electric trains, we have them anyway. But if you do some kind of Green New Deal in Germany, that gives a lot of employment and work to the companies in Germany. If you have that in other countries, probably not so much. So because the resources in the Eurozone are limited, it does make sense actually to starve other countries of money so that the idle resources can be transferred to Germany to help and renew the economy there. So yeah, even within an MMT logic, it works because the fight ultimately is about the resources and not about the money.
And to cap this topic off, if I may, as you noted in one of your Twitter exchanges, Dirk, the point is that the political rules, debt breaks, deficit limits as such are negotiable. MMT makes this visible.
Yeah, I think that's very important that the people know that you can pay for anything, even in the Eurozone. So all the national central banks can create euros, but only within the monetary contract more or less that we have signed. So the treaty, the functioning of the European Union. So as Keynes said, what is possible to build more or less is possible also to finance. That also applies to us. So it's a political game here about access to resources.
So looking ahead to the third European MMT conference, which we're pleased to announce will take place in Berlin on the 9th and 10th of September. And I believe we can announce that Nathan Tankus, Yevhen Assisian and L. Randall Ray are confirmed as speakers at this point. And one of the themes will undoubtedly be understanding and navigating financial crises. And related to that, you recently wrote about how in Switzerland, the Swiss central bank grants loans to its member banks, so commercial banks, without collateral. And that's a break with traditional central bank doctrine. Tell us more about that.
Well, the listeners of your show, they all know that banks are agents of the state, right? And that they can create promises to pay the state's currency, and they need the infrastructure of the government to do that. So it's access to the central bank's payment system, access to the government's cash. So the question, of course, is how do you regulate these kind of institutions? So you don't want to have banks which give out lots of loans and not much is repaid. Okay, this is like trading money for free, and you don't want that. So this is why the central bank says, well, you can only borrow from us against collateral. Okay, so you have to have good assets if you're a bank that you have to post as collateral, and then you get central bank money, which means then you can give cash to your customers, then you can make payments to other banks, net payments or gross payments, doesn't matter. So it's part of the regulation of the banking system that the central bank says we only give loans against collateral. And if you are a bank which is becoming a bad bank, so the loans are written down because the probability of repayment is, 50%, then of course these loans, they're not good collateral anymore, and you will get a haircut, which means that you will not be able to borrow central bank money at the full amount of the loan, but only at, say, 50%. So this is why the central banks have been doing this kind of thing, that they say, okay, we lend out only against collateral. Of course, when you have a bank which is not working well, and Credit Suisse is one of those, I have to tell you that I found lots of interesting stuff about Silicon Valley Bank and why it failed. But Credit Suisse, I have no details here, whatever happened there. But of course, normally you would say, well, if you have no eligible collateral, well, you cannot borrow from us. And if that means you are illiquid, well, we will close you down. Because if you're illiquid, you're probably also insolvent or on the way of becoming insolvent, meaning that liabilities are higher than assets, which means that if there's a run, you cannot pay out your customers. So that's odd. So it's the Central Bank of Switzerland, and Switzerland itself, it's very conservative as a country. And to open the gates like that, it's very strange to be honest. So normally what you would want to see, either the bank being closed and nationalized, and then maybe sold back into the private sector after ensuring that it has some kind of business concept which works. But yeah, it's very odd to see this happening in Switzerland, of all places.
Randy Wray also highlighted that during the financial crash, the central bank, the Fed, was granting loans with collateral that shouldn't have been taken as collateral. And the implication was that the central banks were being quite lenient to the banks and propping them up, effectively knowing that they were bad banks and that they shouldn't really exist.
So what we're saying here is that the Swiss central bank is doing that to the max.
Yeah, that is just another step on that. But I wonder, there is a revolving door between central banks and commercial banks. And can we call this corruption?
Yeah, this is a very big question. So is the central bank the patron of the banking system? Is it somehow supporting the banking system? Does it identify with the banks too much, maybe? It should be part of the government. They should be a public institution, and then they should be concerned with whether the banks are working in the sense that public purpose is served. But there's a big difference between the financial crisis of 2008 and 2009 and what's happening today. Because in 2008 and 2009, also with the ECB, for example, if all the banks' assets are written down because of the real estate problem, and then also the share prices are dropping, then of course you have a full-blown banking crisis. So all of the banks are telling the central bank, look, we are running out of collateral. And we know that the others are running out of collateral too. So that means we will call in all our interbank loans, and we will give no more interbank loans to anybody else, because we know that our problem is also their problem. So in that situation, you have to reduce the collateral requirements. And then, of course, you have to take collateral that before you would not be willing to accept, because if you play hard, otherwise you would basically have a banking system where all the banks are failing except maybe Goldman Sachs, at least in 2008, 2009. So now it's more than odd, because you only have Credit Suisse with problems. UBS is fine and other banks are fine. So to change the rules just for one bank, that's a very odd move. And yeah, you are right. One has to wonder why the Central Bank of Switzerland is doing that, because I think it's not within their mandate to create this merger between those two banks, Credit Suisse and UBS. But I think probably more information will come out in the next couple of weeks and months about what happens there, because the regulators probably will have to justify themselves in front of the Swiss parliament, I guess.
But they only have to justify themselves because they've been found out, right? They do this behind the scenes and only when people look into the detail. If they had to take something like that and it was absolutely necessary for the financial stability of the country, then at the very least we can expect is them being transparent about it. And I don't know, having authorization from parliament or something to get out of their brief in order to do something like this. But I just think it happens too often.
Yeah, no, there's a big debate with also Warren Mosler jumping in there. And Warren says, well, the central bank is underwriting all the assets a bank have anyway. Okay, so how do we ensure that the banks do not have bad assets or bad loans? Well, we should have good banking regulation. Okay, so that ensures that they don't make the bad loans in the first place. Now, once we have the bad loans, they will blow up anyway. Okay, so it's just a question of how they will blow up and who's going to pay for it. And we always protect the depositors. Okay, so that was also part of the conversation about Silicon Valley Bank. Why do you have this idea of protecting depositors only up to $250,000, for example? Why not unlimited? What's the point there? If you have a limit of $250,000, then of course the risk managers of any company should just say, well, if we go beyond $250,000 in our bank account, we just buy government bonds with that money, treasury securities, because they are safe, just like short term, 3 months maybe. So if you can protect your money anyway like this, then you could say, well, maybe you could just have deposit insurance up to, unlimited maybe, because it doesn't really change the way that the monetary system is working, except that banks don't have this problem anymore, that there's a run if something goes wrong on the asset side. So that would give banks more time to react to asset side problems. Because, I think that there's this big debate about whether you should have banking regulation that kind of hits the banks before they make loans, or whether you have ex post kind of reserve requirements, capital or equity ratios, blah, blah, blah. And I think that the approach that we had in the last couple of decades has failed. So we should have more banking regulation and more strict banking regulation, telling them in much more detail what they can and what they cannot do. Warren Mosler has this proposal out also about re-regulating financial markets, the Fed, and so on. I think we might have to write up a European version of that at some point to explain in more detail what that means in practice.
Well, watch this space. So turning the corner and moving on to inflation, to me, the big inflation story of this week was oil, OPEC cutting production. Dirk, would you mind talking about the link between OPEC as a price setter and inflation?
Yeah, well, the energy price is very important because it goes into the CPI, the Consumer Price Index. And if gas gets to be more expensive at the pump, then of course we pay a higher price and inflation goes up. So if we have to import a lot of energy and we use that energy in our economies, then of course we cannot control the inflation rate because we're always dependent on the oil price. And if OPEC is cutting production and the oil price goes up, then there's not much you can do about it. The inflation rate will have to go up. The only thing that you could do, of course, is to not rely on oil anymore. So if you don't consume oil inside your country, then of course the oil price will not go into the consumer price index, and that means it will not influence the inflation rate. So the mid to long-term strategy that protects you against this kind of a driver of inflation, and OPEC, of course, is more or less either a monopoly or an oligopoly situation. It's a cartel. So you wouldn't expect that this would be a competitive price somehow in an equilibrium of supply and demand, because you can just see what they do. When the price goes down, they cut supply. Okay, so this is not about supply and demand somehow settling to find equilibrium price. That they want to have a certain kind of price and they adjust supply to demand to get that price. And that means that, again, if you are the central bank, you will not be able to control the rate of inflation. It's going to be impossible. And if you try to crash your economy to bring down the price of oil, that's a very stupid idea. That's like blowing up the garden to get rid of some weeds. That's not going to work.
And on this topic of central banks blowing up gardens, interested to see this week Fabio Panetta, who is a member of the executive board of the ECB. He was interviewed by the New York Times, and in the interview, he says he's concerned about a profit price spiral. I guess this is what other people have been calling greedflation. Can you tell us what that is and what your thoughts are on that?
In the last couple of months, we had some empirical evidence in the Eurozone, also in Germany, that a significant amount of sectors which did not experience a rise in costs nevertheless increased prices, because they just thought, well, everybody else is raising prices by about 10%, so why not do it? Okay, so the consumers probably won't notice the difference between a company which charges a higher price because costs have gone up and a company that charges a higher price because they want to have higher profits at constant costs. So there was a piece by a conservative think tank in Munich which discussed this. And also ECB also discussed that internally. And then they wrote an article about this online on the webpage, which was a little bit odd because it seemed like they were more afraid of a wage price spiral than a profit price spiral. And they said, well, if profits go up, then the price goes up, but then wages should not go up because then you get a wage price spiral. But if you think it through, then the workers will always lose from inflation because the companies, they're not hindered or stopped by the ECB to increase profits. So if the prices are rising because of higher profits, then of course you lose purchasing power if you are a worker. So what the ECB should have done is they should have said, well, if we have a profit price spiral caused by companies being greedy, well, then we as the ECB have to work together with the national institutions that watch over market power, cartels, and monopoly situations. So the regulators of competitive markets. I think that's what they should have done instead of telling us that only workers can lose in times of inflation. I mean, that was something which I was very astonished to hear that. But it's good, of course, that now the ECB is getting into this topic and, well, at least they know it's there. They have no instrument to address this, but it just helps us to see one more time that the central bank is more or less helpless when it comes to distributional conflicts like this.
Which is what inflation is, according to a lot of people.
Yep.
It's interesting on the Financial Times. They seem to be saying that the price rise this week was mainly driven by traders looking to cover short positions, but expects a much shorter price surge later in the year. Any knowledge of that? How traders may be influencing the price rises in Saudi Arabia?
Yeah, I mean, there was a book about the industry of those traders in oil, traders in raw materials. And I mean, that's something which for us as economists normally is a black box. But yes, I mean, with all these short positions, long positions, I mean, this just increases volatility. And that's not a good thing. So yeah, I mean, things are getting complicated also because if Russia, for example, sells less gas to Western Europe, they will sell more to other parts of the world. And then you get these effects that, for example, India is selling liquefied gas to Germany, which because they always have had liquefied gas, but now they can get cheap gas from Russia and they make a profit. So Russia is now indirectly, in the sense, selling gas to Germany. And this, of course, is very profitable for a lot of people. So you have the speculators in there, and not only the financial speculation, but also the speculators who are trying to look at arbitrage opportunities. Okay, so they say, well, it's legal for Russia to export oil and gas to India, and it's legal for India to export liquefied gas to Germany. So that's arbitrage because the gas from Russia is much cheaper than the liquefied gas that is sold on to Germany. So, of course, these intermediaries, financial and real speculators, they create a lot of tension and they probably also have a lot of influence on the price in both directions. So it's becoming a bit like a lottery because, the volatility has just increased so much.
I wanted to just throw this in there as well because I think MMT's got a bearing on this in current affairs. This week, I believe politically, Finland moved to the right. And I'm not very conversant with Finnish politics. Sorry to our Finnish listeners. But I believe the new leader, Petteri Orpo, beat the old leader, Sanna Marin, by arguing that Finland's national debt, or as we like to say, national so-called debt, is too high. And therefore, the public spending needs to be cut and austerity, basically. Have you got any thoughts about that, Dirk?
Yeah, that's very odd, this Finnish situation, because the public debt to GDP ratio in Finland is currently at 72%, which is not high. 72 is really below average compared to other countries. I think the UK's level is 100% of GDP right now. So, I mean, public debt is really just the money that the government has spent into existence, trying to pursue the public purpose, and it has not taxed that money back yet. So that's what the public debt is. It's nothing that has to be repaid. So it can only be brought back to zero by having tax revenues increase without the economy collapsing, which is possible if you tax the rich, but not if you tax everybody, increase VAT or things like that.
I just get the feeling that even if the public debt was negative, they'd still say it's too high. Yeah, it doesn't seem to matter how low it is compared to other countries.
Yeah, I think it's probably, again, politics more than economics. You're trying to get elected and you say what you think will get you elected and you don't say what you think will bring you forward economically.
But this is why, just to reinforce, this is why we like to talk about this stuff and publish about it as much as possible, because obviously the public debt being too high it's obviously a fallacy that moves politics in one direction, and a direction that I think we don't want to go in as humanity. So I just wanted to throw that out there.
There has been a Finnish translation of my book, so I have this introduction into MMT. So maybe we can post a link into the show notes so that the Finnish listeners here, or those who know people in Finland who are in favor of austerity, can read the book in Finnish.
Great. See, one of my favorite authors is Finnish, Antti Tuomanen. I haven't pronounced that right, but fantastically funny crime writer. Anyway, that was just by the by. So just to bring it back to where we started, taxation, we often talk about how taxation functions to regulate aggregate demand, i.e. the spending power of the non-government sector, that's us, and how this is one potential way to fight inflation. But some people interpret that as us saying that MMT's only remedy for inflation is raising taxes. And because raising taxes is politically unpopular, perhaps even politically impossible, the argument goes this means that effectively MMT doesn't have any real solution to inflation. Dirk, what's your response to that?
So MMT does say that tax revenues reduce purchasing power in the private sector. So probably it also reduces the rate of inflation, but it's a big if. In industrial societies, we have increasing returns to scale. That means that the more we produce, the lower the costs are, and that means also that the lower the prices are. So what MMT does say is that inflation, it's a bit like when you have fever. So when you have fever, don't go out and fight the fever. I mean, you can take some pills and try to bring the fever down, but the fever has a cause, and you have to find the cause. And if you want to get rid of that fever for good, you have to address the cause of that fever. And that's always a complex issue. Okay, so, I think that inflation is always a phenomenon of price setting. Okay, so if you have prices going up in a lot of sectors, well, you should look at the firms and ask them, okay, so why are you increasing prices? And normally the answer will be, well, because costs have increased. We just talked about the fact that also sometimes they say, well, let's just increase the profit margin and add to our price without an increase in costs. But normally they say something like, okay, wages have increased, or the price of energy has gone up, or we use some raw materials and they're getting really scarce and price has increased by a lot, so we have to charge more. So when you get these kind of supply issues, you have to address those supply issues. So it's maybe a little bit odd, but modern monetary theory is not something which says that the supply side, the production side does not matter, that only money matters. No, it's the opposite. So if you have inflation arising because, you have a scarcity of workers, driving lorries, for example, when the solution would be to have more lorry drivers and then to maybe have higher wages in that sector, or to have, more people doing apprenticeships as lorry drivers. I don't know if you have that in the UK, or we have that here. So yeah, every time you have inflation, you have to look very carefully, what is the cause? And if you're using Milton Friedman's lens, then the cause will always be a higher money supply, but the numbers don't add up. So I think some of the monetary supply numbers are now in negative territory, but I don't think we will see deflation. So empirically, we can say that these ideas of too much money causing inflation are just plain wrong. Also in 2020, we had huge government deficits and lots of money, but in 2020, the rate of inflation was really low. So it seems to be caused more by the energy price, for example, going up and down. And sometimes, again, driven by profits increasing, by firms exploiting their market power. So that means that MMT has a lot of different ideas about how to stabilize the rate of inflation. We have the job guarantee, for instance. To do that, we also think that we should park the interest rate at the central bank, maybe at 0%, maybe at the inflation target rate, which would be roughly 2%. Also, we can have the automatic stabilizer strengthened, so to make sure that when the economy is running hot, that then the income tax rates go up maybe, or that people who have more income then get into higher tax brackets. We can think about all kinds of policies. I think probably, Patricia, you are more the expert on this topic than I am. So there's many things we could do to help the government figure out what is it that's driving inflation and how can we make sure that the prices come back down.
So I was thinking of what the best way to summarize this idea, because you're right. There's so many different things that could be done depending on the situation, what the best route to do that is. I still think MMT is right to say that tax is the primary thing that gives money value and therefore the primary kind of price stabilization mechanism. So I'm wondering whether we can phrase it in this way. To the extent that inflation is caused by excessive demand, then taxation could be a good way of addressing it, or alternatively, some sort of encouraging savings in the population. But if the inflation is caused by supply side issues, which is very often, more often than people realize, then actually taxation may not be the best way to deal with it. And you may actually need even more spending to activate more supply in the economy. Is that a good summary, you think?
Yeah, that's also what the federal government in Germany did. Last year, when inflation was really high, they introduced the €9 ticket for local public transport. So you could use all buses in Berlin, Hamburg, Munich, and all the other cities for €9 a month. Also some of the interregional trains, which was great. And we had a rebate for those people who filled up their gas tank at the station. So we already live in a world where economic policy ignores the mainstream ideas about how monetary policy works, about how fiscal policy works. So even with the government, where you have now in Germany a liberal finance minister, they spend money in order to bring down the price level. Okay, so they're already doing that. So I always say that MMT has been completely underestimated. So in practice, a lot of politicians have stopped listening to our colleagues who are saying that it's only the central bank which can deal with inflation. It's rubbish, and you will not get re-elected if you follow this idea, because the people will vote you out of office because they say, well, you are responsible. And in Germany, the numbers for the federal government don't look good. So the majority is gone. So if we would have elections today, the parties that are now in power would have a combined 42% instead of 50 plus, which they had when they were elected into power. So of course, we have a huge loss of purchasing power all over the Eurozone because wages are not increasing. And that's a big political problem. And that needs to be fixed. Right now, the workers of the Eurozone are carrying the burden. Just like in the UK, where you have enough is enough. We have similar ideas here about policies that we would need and about movements that are starting from a street level. But yeah, there's no mechanisms in place that help us bring purchasing power back up, because the energy prices have now returned to where they were in 2019, but the prices didn't. And one way to stop companies from raising prices without a proper raise in costs is to raise wages afterwards. So they would say, well, okay, of course, we could increase prices without increasing costs, but afterwards the workers will have a wage rise, and that will, of course, eat up the increase in our profit. So we might as well leave it. So this is a very interesting power play that we see right now all over the world, where companies are trying to exploit their power, and the workers will have to get their act together, and the unions will have to stand up and demand higher wage rises. So yeah, that will play out over the next couple of months, I guess.
Inflation is fascinated in that it very often serves as a symptom of some underlying political games going on. I just find it interesting for that.
Great stuff. So before we go, Dirk, and this is a very leading question, are there any forthcoming events, online or otherwise, that folks listening right now can put in their diaries and get excited about?
Yeah, well, thanks for asking me this question, Christian. There's going to be the Poznan Summer School in MMT, which is in September, and probably you will have a link up in the notes. And then followed by the summer school, we have the conference in Berlin, which you already mentioned. And for those who want to prepare themselves for that, I will also teach this course at the Maastricht Summer School in the Netherlands from July 31st to August the 4th. So that's going to be 2.5 hours of lectures per day about the Eurozone MMT if you want. So yeah, that's the stuff that I'm looking forward. I'm also going to be in the US. There's going to be it's called the OSUN workshop at Bard College in June, but I think it's already closed. But that would also be something to consider in the future if you have the chance to go.
And also, last time we spoke about your Essentials book that's going to be translated into English for, I guess, the American audience. Any news on the date on that?
Yeah, well, the publisher just told me that they want a book which is double the size, because the publisher had, a book series where they just had an introduction to this and that, and it shouldn't be over 50 pages, and they don't have that in the US. So yeah, I will have to rework the text and make it a lot bigger.
It's a new book, basically.
And of course, it will include a lot of things that have been debated in the last couple of months. It will also have a section on the debt ceiling, about PayGo, about Silicon Valley Bank, and the libertarians who have turned into tame little cats now. So it will be an updated MMT introduction, but it will address people who are interested in MMT and they want to read a short introduction of maybe 100 pages, which is for the lay public. That's roughly the idea of the book. And also people who are working with money. So I will talk also about bank regulation and what kind of institutions you need for the capitalist part of the economy to work properly, and what kind of institutions you need for the non-profit part, so the government part of the economy, where you can just spend your money and resource things. But where opportunity costs matter because you take away resources from the economy. So it will be a different book, but hopefully it will be finished soon and then maybe out in this fall.
Great. So lots to look forward to. That's a great place to leave it. We've been speaking to Dr. Dirk Ehnts. We'll link to where you can stay current with his work and about all the events we just talked about in the show notes for this episode. And also, if any of the stuff we talked about here has left you with questions, I'll try to include as many links as possible to other episodes and articles, which will hopefully help you further your understanding. And there'll also be a link to where you can get free tickets to the book launch of the new anthology, MMT Key Insights Leading Thinkers. That takes place in London on the 20th of April. Me and Patricia will be there. We hope to see you there. But for now, thanks so much for joining us once again today on the MMT podcast, Dr. Dirk Ehnts.
Thanks a lot for having me. It was a great show.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.